Why employ Ethereum-based treasury strategy? Why not a Bitcoin or a Solana or another token?
I believe Ethereum to be the next generation of the internet. And it is the only available substrate that nation states, Fortune 500 corporates, and regular people like you and me will be able to trustlessly interact on a global scale. And it is experiencing parallel dynamics similar to Google with search, where with Google, 90% of searches happen there, and 1% happens on Bing, 1% happens on Ask Jeeves, 1% happens on Yahoo. And 90% of high quality liquid assets, which is a defined term by the Financial Accounting Standards Body, HQLA, are settled on top of Ethereum. And basically the next largest competitor has about 9%, and then it continues to kind of fall off the beaten path. So basically, A, liquidity begets liquidity. B, it is the only one that has, and there's a point of client diversity. So there are 12 implementations of Ethereum now. There's a Java client, a .NET client, a Haskell client, and all of these clients have to form consensus with each other every 6 seconds as a block propagates. To give you an idea, Bitcoin has one, Bitcoin Core, and Solana has one, just to give you kind of an idea there. It is the most decentralized. It has the most validators around the world that are forming consensus and has had 100% uptime since inception. And so basically, we've gotten this platform that works, that is attracted the most amount of capital, that has decentralized client diversity. And lastly, it's kind of a historic technology lesson. Java became J2EE, Java 2 Enterprise Edition, and it became the most permeated software language in the world when it converted from Java to J2EE. And what that basically was is it created standards. And it had clean web APIs and clean database APIs. So if you were a developer in Mumbai, Paris, San Francisco, New York, Houston, wherever you were using the same standards. And what we've seen is the modularity of standards that are created. So basically, one example is the ERC20 token standard. And that ERC20 can go into the wallet standard. So basically, anyone in the world could create a token that represents some type of asset, and that asset would fit safely into a wallet. And because of this, we've been able to build different types of tools that all work together. And that's created this zeitgeist, Cambrian explosion, whatever cliche you want to use, and has propagated Ethereum to kind of the most used developer ecosystem with the most distributed validator set, and I guess most importantly, the most amount of assets by a factor of 9x.
Yeah, and if you're listening and you don't know the different standards within Ethereum, don't worry about that. If ERC20 isn't necessarily mean anything to you, you don't need to know that. What you need to know is you need these standards in order to achieve mass adoption, because you need millions of developers around the world building in your ecosystem, and these standards exist very strongly. And we're really a part of the initial building of Ethereum. These standards were very well thought out by the team
It's
in
the
the early
first
days,
inning.
which,
The
yeah,
first inning.
exactly. And it shows how earlier, I mean, you use the JavaScript example. What is there, 16 million JavaScript developers in the world? And there's about 20,000 Ethereum developers. Like, we're so early, so early. Uh, okay, I want to shift gears for a second to DATs. So um, I want our audience to understand the difference between different DATs. And this is going to get a little bit nuanced because I think you can really get into the weeds of the differences. But let's start by talking about the Ether machine and the way you're building the Ether
Sure.
machine. And then we can talk about the other DATs and how
Sure.
they're built differently.
Sure. So I guess I'll talk about this from kind of being patient zero, and I'll let Andreka chime in, and I'll shut up. But basically, I was going to commit capital to this endeavor because it was my strong opinion that this was the best way for public market investors to have access to Ethereum and Ethereum's yield generation. And basically, we've talked about the on-chain yield generation. And then there are other things that one can do when one has a public company. And that is, let's call it off-chain ability to increase one's ether concentration per share. And that, I think, is an important topic for us to understand. Our North Star metric is if we have an investor that purchases 1,000 shares, for example, and that 1,000 shares equals 1 ether, we have to be able to increase the amount of ether they have per those 1,000 shares. So the goal would be to increase that, 1 ether to 2 ether. And we can do this on chain by participating in staking, restaking in DeFi. And we can do it off chain by using the public equity and debt markets to basically acquire more ether. And this is really what Michael Saylor with MicroStrategy pioneered. And he should be given credit. And basically what he was able to do was he was able to issue bonds. And with those bonds, there were bond holders that wanted to acquire volatility. And then with the dollars he received from those bonds, he was able to purchase additional shares additional Bitcoin for the shareholders that wanted additional Bitcoin concentration per their shares. So I thought that this was the right vehicle because Ether has double the volatility of Bitcoin and it has the ability to generate yield, which Bitcoin doesn't have. So when I went down the rabbit hole, I said, well, Ether is a better mousetrap than Bitcoin because it's a productive asset that has double the volatility, which would be more valuable to bondholders. And then I went down the path, and broadly speaking, there are two paths one can go. One can do what's called a reverse takeover of a shell company, or they can create a de novo or a brand new entity and do a merger with a special purpose acquisition company. And Draka is the subject matter expert of special purpose acquisition companies. And I had a few conversations with a few shell companies, and I knew that I wouldn't feel comfortable putting my capital there. And as patient zero that deployed 170,000 ether into this vehicle to lead by example, as I wouldn't suggest someone else do something that I wouldn't do, I learned very quickly I wasn't comfortable with what I would call contingent liabilities. And I'll just give you a quick anecdote on some of these types of contingent liabilities. I talked to one, which was a dying biotech, where the drug didn't make it through clinical trials. And so basically the company was going to go bankrupt, and the CEO would have to stay on the board due to control provisions. You can't just, if you have a publicly traded company, just change the management, willy-nilly. And the CEO wanted $5 million a year and couldn't spell Ethereum. And basically, I didn't want to deal with a pre-existing operating business. Another one was a Bitcoin mining company that had a data center lease for 10 years. They were in year 4 of 10, and it cost $10 million a year for this data center. And with Ethereum, you don't need the data center because they don't do proof of work mining. And so that would have been a $10 million year leakage, ongoing. There are other ones that are basically saving capital that are invested in these treasuries to potentially settle lawsuits, because you basically are inheriting a company that has a 4-year statute of limitations. So what they've done for the last 4 years, maybe while their microcap or their market cap is effectively zero, isn't worth a lawsuit. But once $1 billion is put in of digital assets, that becomes kind of a honeypot for class action lawyers. So very quickly, I said I didn't want to inherit an existing operating business, an existing management team, existing potential liabilities in these, these lawsuits that have statutes of limitations of the last 4 years that I don't know. And so what we've done is we formed a de novo brand new LLC, and we merge that with a special purpose acquisition company. And maybe Andrejka would be best to explain kind of what a special purpose acquisition company is and kind of the value that a special purpose acquisition company provides.
That's great. I'm going to exit the interview, actually. You guys can interview each other. Perfect. That was my next question, Andrew. I love it. Okay. Thanks for watching. Make sure you subscribe to the Milk Road Daily YouTube channel. And if you enjoyed this clip, you can watch the full episode here.